Most people waste years trying to pay off their debt simply because of how they schedule their payments. Today, I'm going to show you how the frequency of your payment is much more important than the amount that you pay. Let's go ahead and take care of this $50,000 loan. The math might shock you. So we're going to go ahead and start right off the bat with this $50,000 loan. And I know that you're probably used to seeing $50,000 get crushed by $1,000, get crushed by, I guess like $900, right? But we want to go ahead and share with you another aspect of debt payoff. Now we have $50,000 at 6%. This is going to equal $730 each and every month. And oh, by the way, it's going to be at 7 years. Okay. Now, again, we want to reiterate, and we can't say this enough times, that $730 is not going towards the principal. It will be split up. Now we want to take you to how it's split up, first of all, and then we want to share with you how to pay this so that you're not in the loan for 7 years and that you capture the $730 each month for yourself instead of the bank. So let's go ahead and look at how it's split up. Okay, it's split up between interest and principal. How much in each year? Okay, we're going to go ahead and do it by increments. 1 month, 12 month, 24 month, and 36 months. So what does that look like? That looks like this. We're going to split it up in the regular payment. Okay, this is how much you're going to be paying. This is how much goes where. On the first month, of course, $250 goes towards the interest. $480 goes towards the principal. The 12th month, that's a year later, that's $223 on the interest side, $507 principal. We have the 24-month, $191. Okay, it is going down. $539 for the principal. And then finally, the 36th month, that's going to leave us at $158 on the interest side, and then $572 on the principal side. Now, this is how it's going to look when you're talking about any amortized loan. Remember, amortize, that means death, okay? Mort. It has that word in there. And I want you to realize that this is going to be how your payments are split up. All right. Now, notice at each month you are paying towards the interest, but it's getting less and less. Do you know why that is? It's because of the interest. The interest is getting taken out, right, at the $480, right, the first month, and then some goes towards that principal. That's less than the interest will be eating on. Now, that's going to be very important as we go through this lesson, because I'm going to share with you what's even better than putting $500, $1,000 a month towards this loan. I'm going to share with you something that's much better than that, okay? Let's go ahead and share with you the $500 each month on top of your regular monthly payment. You already know how that goes, right? You're going to make sure that you put it towards the principal. But I do need to share this with you because as I take you on this other method, you're going to be shocked as to how much frequency is playing a major role in getting these debts eliminated very quickly. Matter of fact, let me ask you a question. If you could get rid of your car loan or any loan today that's causing you trouble, what would you spend it on? Go ahead, comment below. What would you spend that on? Okay, let's go ahead and make sure that we have the $500 example here. So as we go over these numbers here, I want you to keep in mind that we're going to be paying out extra each month, the same amount. But I want you to notice the frequency making a difference in that principal. Now, month one on the $500 extra, that's on top of our $730 a month. 1 month, $250 towards the interest. Then we've got, of course, $980 towards the interest. Remember that $500 is going towards the principal. On the 12th month, that's 1 year, we have $194. So it did go down significantly. And then we got $1,036 to the principal. And then we have the 24th month, look at the 2-year mark, how you're still going down. You're not paying the bank as much interest, $131, and towards the principal, look at how that principal is going up. It's getting inflated. How is that happening? Because the interest dollars are being transferred towards the principal. Remember, when you knock that principal down, the interest has to feed off of the principal. And the lower it goes, the less the bank gets. So let's see at the 3-year mark where we are. This is where we want to be. $63 towards the bank, $1,167 towards the principal. This is something I've never shared with you before. It's the same amount. Now we're going on this side, but in different intervals, okay? More frequent payments. Let's go ahead and do it. $250 multiplied by 2, that means we're going to be paying bi-weekly. What does that mean? Well, let's go ahead and take the 1st and the 15th, right? Month 1, because we're paying the 1st and the 15th, we're going to be splitting up that payment, right? Of $336, all right? Yes, the game has changed completely, but we have to keep in mind that we're paying that extra $250 bi-weekly. So what is it going to look like? $115 goes towards interest, $471 goes towards that principal. Now on the 15th, $113 goes towards the interest and $473 towards that principal. Now stop right there. Already look at how much less you're paying in interest with this bi-weekly plan, okay? $228, 115 plus 113 versus $250. Which one would you rather pay, okay? Because the more you're knocking out that principal, right? The more frequently you're knocking out the principal, you're going to be seeing payments like this towards the bank. Why? Because the bank doesn't like it when you start frequently paying, right? Even if it's the same amount. If you start knocking down those interest payments, the bank is going to get less and less. And we're going to see that in the next 4 examples. We have the 1st and the 15th. On the 12th month, look at how much we're paying toward the bank. $85 on the 1st. $83 on the 15th. Let's just hop right into the 24th month. That's our 2-year mark. We have $54 on the 1st and then $53 towards the bank on the 15th. And of course, look at how much we have increased on the principal. You may say, CJ, how in the world is that happening? It's because you're making more payments in the year. The frequency went from 12 payments to 26 payments. Okay. And remember, when you have 26 payments, what does that mean? 26 payments equals 13 full payments. Okay. That's what that means. Go ahead and write that down. This is applicable, especially if you're talking about mortgages as well. Car loans, any loan. You need to make sure you amp up the frequency of your payments. That way you can get them paid off much faster. Now, what I want you to do is I want you to know that the extra payment, okay, is still the same, $500 and then $250. Multiplied by 2 is $500, okay? We've got the bi-weekly payment on over here and the $500 payment over there. Let's go ahead and see how much we paid with each and how much we saved in interest when we're paying like this. So we paid $5,729 on the bi-weekly side. On the $500 a month side, we paid $6,033. Let's see how much we saved. On the bi-weekly side, $5,543. And then on the monthly side, $5,322. So I need to ask you a question. What is your goal? Is your goal to pay the most interest or less interest? because you're going to get out of here in about 4 years. Remember, those extra payments, they're still the same. It's just the frequency. All right. So you're going to get out not in 7 years. So remember, over here, as you're continuing to pay by the bank's plan, that's the 7-year plan. Or maybe yours is a 10-year plan, 30-year plan. All right. I know that they even have mortgages that are 40 years. But you don't have to take that anymore, all right? So look at this. Which one would you rather have? Where would you rather spend your money? What is the easiest for you? What's the simplest for you? Please let us know down there in the comments below. And I want you to know something. I know that you can probably do way more in extra payments than this. However, if you're paying it more frequently, you're going to make sure that you're saving and paying, right? You're saving in interest more and you're paying in interest less, okay? And that's going to make sure your time in that loan is shortened, okay? As it was here, right? Because what is it all about? It's all about capturing this cash flow. And guys, I haven't even started on what happens when you use your line of credit in a bi-weekly manner. We're talking about going on a whole nother level, okay? So remember over here, the interest you're gonna be paying, if you continue with the bank's plan, $11,300. But if you use that money that you already have, right? Or maybe it's under your cushions. Maybe it's sitting at a bank somewhere, right? You forgot. You can use that to get rid of these gargantuan loans. And that's how you do it. You don't need $1,000. You just need 500 and you got to use it strategically. All right, folks, I do want you to make sure that you have this. Man, this needs to be a t-shirt. It really does, because this needs to be seen by everyone you come in contact with. It's not just about that extra monthly payment. It's about how you're using it. See, that's another example. Financial allocation strategies and tactics, that's how you increase your cash flow, and that's how you eliminate debt. Now, look, if you got any value from this, go ahead and smash that like button. And if you need more videos on how to get rid of gargantuan loans the Velocity Banking way, check out this video right here. God bless you, and we'll see you in another video.